Most people think the only way to pay for home renovations is to either save up cash or tap into a home equity line of credit, also known as a HELOC. But here's the problem. A HELOC is based on the equity you already have. What if you don't have much equity yet? Or what if the home that you want to buy needs a ton of work? That's where the renovation loan like at FHA 203K and Fannie Mae's Homestyle come in. And in a lot of cases, they can be a game changer compared to a HELOC. In this video, I'm going to break down when a HELOC makes sense and when a renovation loan is the better move, and how to think about each option like a strategist, not just a borrower. Let's start with the basics. A HELOC, also known as a home equity line of credit, is a revolving line of credit secured by your home. It's usually based on the equity you already have. It often has a variable interest rate, and you can draw from it as needed for projects, emergencies, or anything else. Renovation loans, like the FHA 203K or Fannie Mae's Homestyle, work very differently. These are first mortgages that let you finance both the home and the renovation costs together in one loan, based on the future value of the property after the work is done. So right away, you can see there's a big difference. HELOCs are based on what your home is currently worth, where renovation loans are based on what your home is expected to be worth once all the improvements are complete. The power of the after improved value. This is the number one reason people choose a renovation loan over a HELOC. See, with a HELOC, your borrowing power is capped by the current equity. If your home is worth, say, $400,000 and you owe $320,000, you've got roughly $80,000 in equity. And the lender will only let you tap into a portion of that equity. But with a renovation loan, the lender looks at the after improved value, what the home should be worth once the renovations are complete. That means your renovation budget can be much larger because it's tied to the future value, not just what you have in it today. This is huge for people buying a fixer-upper or doing major upgrades like adding a second story or reconfiguring the layout of the home, or even tackling big structural repairs. The second big reason is the low down payment requirements. FHA's 203K loan can go as low as 3.5% down for qualified borrowers. That makes them incredibly accessible for buyers who don't have a ton of cash just sitting around. With a HELOC, you typically need substantial existing equity. If you're a new home buyer and you're buying a property that needs work, you might not even have the equity yet. So a HELOC just simply isn't even an option. Renovation loans step into that gap. They'll let you do the work now instead of waiting years to build up equity first. The third reason people choose renovation loans over HELOCs is that the simplicity of an all-in-one financing option. With a renovation loan, you can buy the home, finance the renovations, and wrap it all into one single mortgage. That means one closing, one payment, one interest rate. Often that rate is fixed and for a long set period of time. Compared to a HELOC strategy, you buy the home with one mortgage, then later you apply for a HELOC and you hope you qualify, and now you've got a second loan with a separate payment, and usually it's a variable rate. It can make it work, but it's more moving parts and more risk. Now let's talk about credit. FHA 203K loans are generally more flexible on credit scores, and in some cases, borrowers with scores in the low 600s or even lower may still qualify, depending on the lender and the overall risk profile. Fannie Mae Homestyles typically require stronger credit, but it opens up the door to second homes and investment properties and can be great for higher-end renovations. HELOCs, on the other hand, usually require decent credit and solid equity. So if your credit isn't perfect or you're earlier in your home ownership journey, a renovation loan may be the more realistic path. Another big difference is what kind of work that you can actually do. With HELOCs, they're flexible in how you spend the money, but the amount is limited by your equity. They're great for smaller projects or maybe do-it-yourself upgrades or cosmetic improvements, where renovation loans like the 203K and Homestyle can go much bigger. They can cover structural repairs, foundation work, Adding rooms or levels to the home, major layout changes, significant system upgrades to, say, plumbing, electrical, or even the HVAC system. If you're basically transforming the home or bringing a distressed property back to life, a renovation loan is usually the better fit. Now, let's talk about the payments and the risk. With a HELOC, you're often dealing with a variable interest rate. That means your payment can go up over time as rates change. In the early years, you might only be required to pay interest, but eventually the principal kicks in and the payment can jump. With the renovation loan, the renovation costs are rolled into a long-term fixed mortgage. You know your payment, you know your rate, and there's no surprise spike down the road because the Fed decides to raise interest rates. For a lot of people, that predictability is worth a lot. Let's zoom in on who each product is really designed for. The FHA 203K is ideal if you're a primary residence buyer, you want a low down payment, as low as 3.5%, and you need more flexibility around the credit requirements. You're okay with FHA's guidelines and mortgage insurance. With Fannie Mae's home style, it's ideal if you have strong credit and you're looking at a primary home, a second home, or even an investment property. You want more flexibility in the type and the scale of renovations. You're comfortable with the conventional loan guidelines. With HELOCs, it's ideal for you if you already own a home and you have a lot of equity. You're doing smaller to mid-sized projects and you want a line of credit you can tap in over time. You're okay with a variable rate and a second payment. Let me give you a few quick scenarios to make this real. Scenario 1, the fixer-upper buyer. You find a dated home in a great neighborhood. It needs a new kitchen, baths, maybe some structural work. You don't have a ton of cash and you don't own other homes with equity. A HELOC isn't really an option. A renovation loan, FHA 203K or home style, lets you buy the home and finance the renovations based on the after improved value, all in one convenient loan. Scenario 2, you're an existing homeowner with equity. You've owned your home for 10 years, built up a lot of equity over time, and you want to remodel your kitchen and add a deck. You don't need structural changes, and you like the idea of a flexible line you can draw on as you go. In this case, a HELOC might be perfect. Scenario 3, the big transformation. You want to take a small, outdated property and add a second story, rework the layout, and basically create a whole new home. That's major work. A renovation loan is usually the better tool because it's built for large-scale, value-adding projects and can be done based on the future value of the home. So, how do you decide between a HELOC and a renovation loan? Ask yourself these questions. Do I have significant equity already in the property? If yes, a HELOC might be on the table. If no, look at a renovation loan. Next question. How big is the project? Cosmetic and small projects can be HELOC territory. Structural or major renovations lean more towards the 203K or the home style. Do I need a low down payment or a flexible payment? FHA's 203K is often the best fit here. Do I want one fixed payment or am I okay with a variable line of credit? Remember, renovation loans equals one fixed mortgage. HELOCs equal flexible, but two loans with a variable interest rate. The right answer isn't HELOC is bad or renovation loans are always better. The right answer is use the tool that matches your situation, your goals, and your timeline. If you're thinking about renovating, buying a fixer-upper, or just not sure which option best fits your situation, this is exactly the kind of strategy conversation I love having. Here's what you can do next. Drop a comment with your scenario. Tell me if you're buying, refinancing, or how big the project is, and I'll point you in the right direction. If you found this helpful, hit the like button so more people can see it, and subscribe for more deep dive trainings on smart ways to finance real estate and renovation projects. And if you're ready to explore whether a renovation loan or a HELOC makes sense for you, reach out. Let's run the numbers and see what's possible. Thanks for watching, and remember, the right financing strategy doesn't just pay for your project, it can help you build long-term wealth.